Hello student, welcome back to Indian Business School. We are going to deep dive into the balance sheet overview in specifically inventory part third. So in this we are going to learn about FIFO and LIFO related stuff. So let's jump to the topic. First point is with regard to FIFO. Okay, so in the inventory there are so many different methods to flow the cost. Okay, so FIFO, if you read by this name, you will be able to understand. Sometime when we directly read first in first out and last in first out, we get confused. So here the point is first in first out. So first, which inventory will out, who will in first, who will in first, the oldest inventory will be the first entered into the inventory. Okay, so that is why the oldest inventory is the first in, that will first out. Okay, in LIFO, last in, which inventory will last in, latest inventory. Okay, so you can also keep link with your L is for latest and F is for first in. Oldest inventory will be first out, and the whatever inventory you will out, but cost point of view, your first inventory cost will be charged to your cost of goods. Okay, and for last in, first out means the inventory has been purchased the latest, at the last he has entered into the inventory, he will go out. So the newest, that is why it has mentioned the newest inventory costs are assigned to cost of goods. I hope it is clear to you. So there is one of the example I would like to give that will be helpful to you with regard to FIFO and LIFO. In case of inflation, suppose your price is increasing. Okay, so last year whatever you have purchased, the product price was $10. This year what we are purchasing, their price is $15 for same product. Okay, and selling price may be 20, now it is 22. If you use FIFO method, so what will happen, your oldest inventory will be considered in your cost of goods. Okay, oldest inventory first in, last year the price was 10, so in selling prices, maybe you are in current year, so current year your selling cost would be, you will be charging 22, and you will be reducing what price of goods, oldest price. Okay, then you will be having gross profit of $12. Okay, if you use another method which is LIFO, then what would be the answer? Selling will remain same price, 22. So newest inventory cost, last in. Okay, the latest entry into your inventory. In this inventory, the latest item has been purchased, that cost will be charged. So latest purchase was increased by 15. Okay, so 15 we will reduce. So gross profit would be how much? Around $7. Okay, so you can see how much is the difference, 12 to $7, just because of LIFO and FIFO accounting method. Okay, if you use instead of LIFO, if you use FIFO, our gross profit will be higher side. If you use LIFO, our gross profit will be lower side. This is accounting method. So normally company may change this kind of accounting method and their performance being boosted. Sometimes management will not be able to identify. They will be appreciating the management or finance team that we have generated good profit kind of stuff, and they will also attract the stockholder into the or investor to purchase the share for that particular company. So when we are analyzing this kind of financial statement, also we need to read notes of account. As I have told you, in notes of accounts this has to be mentioned. Okay, so when I would say my student whoever is learning from me, you guys will definitely do and understand while reading this kind of notes, this thing will click into your mind. That is why I'm explaining it to you. Otherwise I would have moved on to weighted average without explaining this point. Okay, I hope it is good for you, and I will be expecting you to forward this course to your near and dear whoever is willing to develop their skill set. Okay, so now we talk about weighted average. Average cost is calculated, okay, summing up the cost of all units and dividing by the number of units. Maybe January 1, whatever you have purchased for $10, for same product if you have purchased in 30th January, maybe $11, and in March cost has been increased to 12, and in December cost has increased till 20. Okay, so number of quantity you have purchased, okay, in Jan, whatever it is, you will multiply, and 30th January whatever you have purchased. Okay, in March or April or June, whatever you have purchased, maybe you have purchased 20, here you have purchased 100, 10, whatever it is, you will club all the cost 1, cost 2, cost 3, cost 4. Okay, so then you will divide by number of products, 30, 30, 60, and 30, 90. So whatever the price will come, average, that is called average price. That cost you will be charging with each product. Okay, so the cost would be same, right? If you club together, that will be your total inventory cost. Maybe 10,000 is the inventory cost, okay, and per unit average cost is coming $10. Okay, so whenever you sold any of the product, so you will charge revenue, whatever your revenue price is, and you will charge your cost of good $10. You will get your gross profit. So this is $10. It is coming. Okay, but initially you have purchased for $10, but later on you are purchasing in $20. Okay, still you have purchased 20 or maybe 50 or 100, whatever it is, but average cost, if it is coming, I think I have given wrong example. If it is the latest price, lowest price is 10 and between 20, so obviously average cost would be 15 or 16, whatever it is. Try to understand the logic. Whatever the latest price is 20, but if you are charging $15 here, average cost is $15, you will charge 15. Okay, and then you will get your gross profit of 85, whatever it is. No matter what is the latest price or what is the beginning price. Okay, what is the oldest inventory price or what is the newest inventory price, we will charge the average of every sale. Okay, I hope it is clear to you. And the last one is specific identification, in which normally we use in jewelry kind of company, in which costs are specifically charged to that particular product. Okay, and that is, we can directly associate those costs to that product. Okay, and any high quality like a Rolex product, okay, a Rolex watch, and Rolls Royce car. Okay, so these are the company, might be they can use specific identification charges based on the product. If you can able to identify those costs, you can charge it. Okay, so let's read it out. Assumption: each unit track individually and often use the high value, as I told you, high value, low quantity product. So your product would be sold very less quantity. Okay, and the price of your product would be very high. For those kind of company, normally jewelry and this kind of Rolls Royce and Rolex kind of company may use this kind of method. Okay, that exact cost of each specific unit sold is recorded, so your gross profit for a particular product would be exactly correct. Okay, but in this method there is average, there is LIFO, there is FIFO method, so that is not 100% correct. These are based on the accounting method or based on our assumption. Okay, so this is the most accurate method, but that is not applicable in case of FMCG. In case of e-commerce business, you cannot able to apply this kind of cost flow. Okay, so I think I'm done for the day. See you into the next session.